Hello, good evening, and welcome to this session on my stock watch list, and also question and answer session. So there isn't a formal presentation as usual. This is just a casual session. I'll just be going through some of the stocks I'm watching, and it's also an opportunity to ask questions regarding the markets, investing, your portfolio, or any issues you're having. So like I say, it's an informal session. I'm not doing a formal presentation per se. So it's just nice and casual. So let's quickly start off by let's going through my watch list, some of the stocks I'm watching. Obviously, as usual, I am not recommending these stocks. So it's not a recommendation. I'm not saying you should go and buy them. So that's my disclaimer. These are the stocks I am watching that I am doing diligence on, and I'm going to take my risks on. So you make your own decision. So this is just some of the stocks I'm watching and looking at. I'll just look at a few of them. And again, it's just trying to go through the principles of analyzing stocks and why you put stocks on your watch list. As you can see, I have at the top of my watch list the P/E ratio meanings, the figures and the meanings, just as a reference point. So usually when I look at stocks, again, we've gone through this during the during the course, during the investing course, how you can analyze stocks and do your fundamental analysis. So this is just a summary, so to speak. So for example, this is a stock I'm looking at, Activision Blizzard, ATVI. Like I said, this is a stock from the gaming industry. The gaming industry is something I've been looking at. Again, you need to know about the industry you want to invest in. So this is some information there I put about the gaming industry. I'm looking at the gaming industry because it's good growth in the gaming industry. It's started to reach over 300 billion by 2025. So there's a lot of growth in that industry. So I started looking at stocks within that industry. And then one of them is this Activision Blizzard. And again, you need to know what that company does, a bit about the company. So you can see here, I said Activision Blizzard is a developer and publisher of interactive entertainment content and services. The company develops and distributes content and services across various gaming platforms. So it just goes on and on. So you need to know about the sector you want to invest in. You need to know about the company you're investing in. And of course, the financials. So looking at the financials, you can see that this is from actually October, October last year. So it shows you that I've been looking at this stock for a while. So from October last year, you can see the current stock price at the time was $80.95. The P ratio was 34, so that was too high for me. I prefer stocks to be undervalued. So with a P ratio of 0 to 10, depending on the stock, I don't mind if it's fair value 10 to 17, but once it goes above 17, I don't like to buy them. So 34 obviously is way high. So I just kept an eye on them, seeing if it come down a bit. And you can see at the time, last year, that was, I looked at the earnings per share, which wasn't good too. You can see from 2018 to 2019, the earnings per share dropped. But you can see checking it today, you can see the stock price has fallen a bit. The P ratio too has fallen. And the earnings per share has actually gone up. So you can see last year it was 1.96 and it's now gone up to 2.85. So it's gone up, which is not a bad thing. But again, the P ratio is too high for my blood. But again, I'll just leave it on my watch list. Again, that's what the watch list is all about. The watch list is just for you to keep stocks on there, to keep an eye on that you're interested in buying, to see if they will eventually fulfill your criteria, whatever criteria you're using. But again, that's the beauty about long-term investing. With long-term investing, there is no rush. You're not trading. So again, it's the importance of differentiating between trading and investing. Trading is short term, investing is long term. And this is invested for the long term. So there's no rush to buy the stock. And also you don't get emotional. Well, I don't get emotional about my trading. No matter how much I love the company or I like the company, if it doesn't fulfill certain criteria, I'm not going to buy it. You know, so for example, this is a good one, this Activision Blizzard, desperate to have company shares in a company in the gaming industry. But the fact I'm desperate to have shares in a company in the gaming industry doesn't mean I'm just going to buy one for the heck of it. It has to still fulfill my criteria. And again, the PE ratio you can see is still too high. Well, it's just coming down from 34 to 23, but still too high. Maybe if it drops to between 10 to 17 fair value, I might then buy it. But again, that's why you keep it on your watch list and just keep an eye on it. Maybe just check it once a month or just every now and again, you can just check and see if it's meeting your criteria. You don't obviously have to check it every day. Again, you're not trading. Just once a month is fine. Even every couple of months, you can check and then just see if it's fulfilling your criteria. For example, now you can see how I haven't checked my watch list for almost a year now. It's October. But now that I have some income coming into my investment account from all the dividend payments I've been receiving, and I want to reinvest all the dividend payments in my account. So now I'm going through my watch list to see if any of the stocks on my watch list fit my criteria. So I'll just look at one or two more and then we'll go to the questions and answers. Like I said, it's not a formal session, it's a casual session. So this is Unilever, another company I really love because it deals with consumer staples. Like I said here, most people tend to be consumers rather than producers. So that's why I like the consumer goods sector because it tends to be resilient even in hard times like this COVID period. And again, it's you knowing about the sector you want to invest in. You need to know a bit about the sector. So like I said, the consumer goods sector is a category of stocks and companies that relate to items purchased by individuals and households rather than manufacturers and industries. So these companies make and sell products that are intended for direct use by individuals. So that's why I like the consumer sector goods. And again, that's why I'm looking at Unilever. Unilever is a very, very old company. So you can see Unilever is based in the UK and was founded in June 1894. So like I said here, talk about resilient and durable. So Unilever has been around for a very long time, 1894, so they must be doing something right. But again, it's not about the fact I love Unilever. The fact it's been around 1894 and it's in the consumer goods sector, which is all the things I like. I'm not just going to just jump and buy it. Again, it still has to fit my criteria. Again, you can see that's last time I checked was in October last year when the stock was 4,000 pence, that's pence, for 4,800 pence. But today it's again dropped to 3,951 pence. And the P ratio has dropped from 20 to 18. It's still not within 10 to 17, but it's getting close. So that's a good thing. Again, looking at the earnings per share, the earnings per share is steady. You can see it's 216 in 2017, 349. It went up in 2018, and 2019 it went down to 215. 2020 213. So it's not too bad. But again, it's not really getting to my PE ratio criteria, at least 10 to 17. I prefer 0 to 10, but for companies like this that I like Unilever, I won't mind 10 to 17, but it's currently 18.75. So I'll continue to keep an eye on it. And then the last one we'll have a look at is Johnson & Johnson, another sector I like, which is about technology and pharmaceutical sector. Like I said, this is, again, when you're looking at company stocks, again, it's about doing proper fundamental analysis. You analyze the country first that the company is based in. You analyze the industry, and then before you start looking at the stock, So you can see I've analyzed the biotech industry, written everything about there. It said the pharmaceutical and biotech industry produces drugs and other products that help people and animals live healthier lives, recover from injuries and fight illnesses. And I go on and on about it. So again, I'm looking at Johnson & Johnson. Again, it's a very popular company. It's a very known and reputable company. It's based in the USA. And again, it was founded in November 1887. So you can see even before Unilever. So again, it's been around for a very long time. But again, you need to know details about the company, which I put there, the company info, what they do. So I have a full detail of what they do. So again, you can see that's the method I use for every stock. I analyze the industry, analyze the company, and then go to the financial. So that's the same. You can see it's the same pattern I use for all the stocks I'm watching or analyzing. And like Johnson & Johnson last year, the stock price was 146. It's gone up today to 165. But again, you can see the P ratio is too high for me. Although it's gone from 25 to 24, but that's still too high for me. So they're all still on my watch list. They're not time to buy them. And I'll just keep an eye on them and keep watching them. So that's the bit on my watch list. So like I said, it's up to you now in terms of questions. If you have any questions, you can either raise your hand or send your question through the chat box. Any questions, comments before we call it an evening? Any questions? Are we all good?
Sorry, I'm just looking for the emoji to raise my hand and I couldn't find it.
That's okay. Go ahead.
Well, recently I've heard debates about a stock market bubble and the possibility of a crash because I think sort of last year a lot of prices fell and then they've all gone up. What's your take on that?
Okay, that's a very good question. Again, that's actually why it's very important to understand the importance or the difference between trading and investing. Because people always underestimate that distinction between a trader and an investor. Because you hear me repeat it a lot, and I say it a lot on the course and all that. But people don't understand the significance, because if you're not thinking right, you make the wrong decisions or you listen to the wrong things. Because when you are a trader, you're looking short term. And all these day-to-day changes and day-to-day things will then affect you as a trader. Keyword is trader, because you're looking short term. Now, when you're looking long-term as an investor, you don't worry too much about all this noise and all this news. Again, yes, let me see if I can Google it. US stock market over the last 30 years. Let's go with 30 years. Okay, so let me see if I can find a chart. Okay, that's a good one. So these are images of these are the images of the Dow Jones over the last 30 years. Can you see that?
Yeah. Yes,
okay. All right. So you can see here, it shows you that, yes, you're going to have ups and downs in the market over the years. But if you're an investor, you're looking long term. Now, if you're now trying to invest, let's start from here, 1936. Yeah. They tell you there's a crash, you panic. It goes up. They tell you there's a crash, you panic. They tell you there's a crash going to come, you panic, you can see how you're going to have a nervous breakdown. If you keep, getting panicked with all this volatility in the market. And it's always the case. They always do that. It's people in the news. You have to remember they're not in the news as investors. They're in the news as reporters. They have to generate news. They have to try and generate some sort of controversy or make it sound exciting and crazy. But, you just have to decide, what are you doing? Are you an investor? Are you looking at the long term? If you're an investor looking at the long term, then you don't panic about, oh, the market is up today, down tomorrow. Luckily, I've been investing over the last 20 years or more now. And I've been through 2 or 3 major market crashes, but I did not exit my portfolio. I did not sell what I had because I know these things come in cycles. It will drop, it will go back up, it will drop, it will go back up. And even despite all what they're saying, like you said, the US stock market, for example, is currently at an all-time high. It's the highest it's been in history. So again, it depends on what you're doing. So yeah, the market does go up and down. The market doesn't go up in a straight line. It never goes down in a straight line. There are ups and downs, there are crashes, there are recessions. Yes, it does. That does happen. That's just a fact of life and a fact of the markets. But in the long run, it tends, the keyword again, tends. I'm not saying it's a guarantee, but the keyword is that it tends to go up in the long run. So if you're a long-term investor, then it's the long term you're looking about. You're not looking about what's going to happen the next month or the next 2 months. And again, that's why, again, it's very important you make that distinction. Are you investing or are you trading? So for example, now, if you want to invest in a UK index fund, the first question, we covered this in the course. The first question you ask yourself, do you think the UK stock market is going to grow and create wealth in the next 5 to 10 years? That's the first question you ask yourself. Do you think the UK stock market is going to create wealth and grow the economy over the next 5 to 10 years? And that's the answer you have to answer first by doing your fundamental analysis. Now, if you now do your fundamental analysis and you feel based on what you've analyzed that you think UK is going to do well in the long run, keyword in the long run, then you buy the index fund. But if UK has a stock crash next month, you're not going to panic because you're looking at the long run. If you're buying ETF in a sector, again, like I showed you with the stocks, if you're buying an ETF, you first have to analyze the sector. Do I think this healthcare sector is going to do well over the next 5 to 10 years? Is there a lot of demand for this health sector? Is there a lot of innovation? Do you think that is going to do well? So based on your analysis, if you now say, yes, I think the health sector, based on my analysis, is going to do well in the next 5 to 10 years, you buy the ETFs to track that sector because you're looking at the long term. You're looking at, okay, the health sector drops next month, you panic. No, you're looking at the long term. Then if you come to the stock itself, if you look at the company, it's okay, I want to buy Apple shares. Is there a lot of demand for Apple, their products? Is there innovation? Is there growth in that sector? Do you think Apple is going to do well in the next 5 to 10 years? You do your analysis of the company, you look at their financials, look at the earnings per share, the P ratio, then you make your decision. So you can see that's why I say you can see the key now, as a long-term investor, that's where you base your decisions on the long term. You don't base it on what's happening on a daily, day-to-day basis. And I actually mentioned it when I was talking about the stocks I'm looking at. You don't base it on emotion. You base it on objective information and objective decisions. Again, like I told you, I'm desperate to get into the gaming sector, get into the consumer sector, biotech sector, although I have ETFs tracking these sectors, but I also want to have individual stocks in these sectors. But again, the fact that I desperately want it, I'm not buying it because it doesn't fulfill my criteria. I'm not emotional about it. You can see I've been looking at this Activision, Unilever, and Johnson & Johnson for over a year. So I'm not bothered about whether people are excited about these companies or they're not, whether they think they're bad or not. I'm not. My decision is based on my criteria, not based about. Now, when you're a trader and you're trading on a daily basis, which I do also, then you can be looking at how the market moves up and down on a daily basis. So yeah, I don't worry about the naysayers that keep shouting the market is going to crash. I've heard that for the last 20 years. If I'd listened to them, I would have been out of the market a long time ago out of fear and panic.
Well, thank you very much. I've got quite a few questions.
No, go ahead. That's what the session is for.
That's
what the session is for.
Yeah, I'll try rush through them. Now, I totally get what you're saying about long-term investing, and I think that's where one of the things you taught us about dollar cost averaging, where there's the benefit to that. But say, for instance, if one buys a stock at and maybe unfortunately you enter the market when it's at a very high price, and then it drops like 50%. I think what I'm trying to say is, at what point is it prudent to say, look, this thing has been dropping, it's dropped 50%. At what point is it prudent to exit?
Okay, that's a good question, and I don't know if you still have the notes from the class, but I actually also covered this because I wrote there so that when I buy stocks, again, I don't do dollar cost averaging on stocks. I only advise you do dollar cost averaging on index funds. You should not do dollar cost averaging on stocks or ETFs. You should only do them on index funds. So that's the first thing. Now, when I buy stocks, once they drop in value by 50%, I sell it regardless. So that's my own stop loss. So if I buy a stock for $10 or £10 per share, once it drops to £5 per share, I'm selling it, period. No ifs, buts, or maybes. But again, it goes back to what I said earlier. Did you do your homework first about that stock before you bought it? So that's the key. So the question is, before you bought that stock, did you analyze the sector of that stock? Did you see that the sector has room for growth? Did you see there was demand in that sector? When you then picked like that company in that sector, did you see that there was a demand for that company's products and services? Did you check whether it was underpriced or overpriced? Did you check if it was a profitable company? You see what I mean?
Yes, yeah. Sorry. I was just going to say, as at last year at the start of the pandemic, I thought it was a good one. It's called Vislink Technologies, and they do stuff for defense. They do live gaming in do you know
the stock code?
I'll see if I can find it.
Or how do you spell it?
VISLINK.
Okay. It's an American company.
It is, yes.
Okay.
But now looking at the data now, it doesn't look good at all. I didn't even know Hargreaves had it, actually.
Okay, let's see. VISL.
Yeah.
VISL. Okay, so let me go to the earnings per share and see. But you can see here it says P ratio is not available, which is not good. But let's go to the earnings per share first, because the P ratio might have been good previously, but now it's terrible. Now, if you see 2016 to 2020 earnings per share, let's see. So you can see from the earnings per share, they've been losing money since 2016. They've never been a profitable company over the last 5 years. You see what I mean?
Yes.
So I'm not saying you shouldn't have bought it. I'm just saying I personally, I wouldn't have bought this sort of company that's not been profitable the last 5 years. It's just been the red.
true. I mean, I had bought it before I did the course.
Oh, okay. Yeah, but it's a good thing you had the experience, because you can see from experience. And in fact, that's why I'm glad you also came on the course, because you can now see the key is how you make the decision. That's always the key. It's the decision-making process that is the key. I'm not saying that you won't buy a stock doing all the right thing and still lose 50%. You could, that can still happen. So I'm not saying that, you know, if you go through the steps, you're definitely going to lose money. You're definitely going to make money. I'm not saying that. There's still a risk. A risk is involved. There's medium risk. You could lose money. You could lose up to 50%, which is my own cutoff mark. That once I lose 50%, but I'm happy to lose 50% based on a company I've done my thorough due diligence and homework on.
Yeah. Okay. All right. Thank you very much.
Pleasure.
My next question. So I don't know if you saw the screenshot I sent you earlier. I think so.
I saw it on the platform.
Search on the platform. Okay.
I actually responded to you on the platform.
Oh, okay. Sorry.
But go ahead.
Yes. So I think, I think the tip was a good one. The amplified transformational data, and the reason that I think it's good is because it's not just looking at blockchain. It also had other companies. I don't know if you're able to pull it up. I think it had NVIDIA. I might be wrong. And I think it had Microsoft. This is amplified transformational data sheet. Yeah, that one.
Are they on the platform? You said they don't have it on Hargreaves Lansdowne.
That's correct. Yes, but then I found it on eToro.
Yeah. Which
was the last message that I sent to you. And I said, oh, but unfortunately, I'm not really familiar with eToro. And I assumed that by buying it, I was actually buying an ETF. But I then got worried after buying it because it said something about CFD, which I know nothing about, which is why I then did the screenshot to send to you.
Yeah, CFDs, I mean, you don't need to look at, it's good because it's good for the recording anyway, so everyone can listen to the recording. And because I responded to your question about CFDs on the platform.
Oh, CDFs, sorry.
CFDs, yeah.
That shows the level of my awareness that I have.
I was one that made the mistake when I was replying to you. I wrote CDFs, so I just put I meant CFDs, not CDFs. But CFDs is called contract for difference. Contract for difference basically means the broker is giving you a derivative of what you're buying. You're not actually buying that thing itself. So for example, let's say you want to buy Facebook. Normally, if you're buying the proper Facebook shares, it's a proper share, you're buying the share, you own the share, you own part of Facebook, you get dividend payment, you can vote, you have voting rights, you can get dividend payment. You're buying a normal share that you buy at the quoted price of the share. Are you following me?
Yes, I am.
Now with a CFD, see, I'm still making a mistake. So with a CFD, what happens is that the broker will form a derivative of Facebook. So they would create an instrument which is out of the blue. They just create something out of the blue. They create an instrument that is now tracking Facebook. So it's a derivative of Facebook. It's not Facebook itself, it's just a derivative. It's like a fake Facebook, it's a derivative, but always is legal. This is all licensed and controlled by the financial authority. So with that derivative, you can track Facebook shares as Facebook, but it's as a derivative, which is what the contract of difference is. The only difference with CFDs is that you don't get paid dividends and you don't have voting rights. Although some CFDs will actually do pay you dividend, but it's really just a derivative of the real thing. But the beauty about CFDs is that sometimes, for example, if Facebook is $100 per share, you might buy a CFD for $20 per share. So they can come in fractional bits, they can play around it. So that way more people can invest in it and play with it and benefit from Facebook itself going up.
Okay. From the screenshot, are you able to tell if what I bought is actually an ETF or a CFD?
No, you have to find out from the broker, unfortunately, because that's where the brokerage fund comes in. Because like I said, when you buy, so for example, now it's a good thing I use Facebook. Even if you bought a CFD of Facebook, it will be showing as you bought Facebook.
I see. All right.
So it is you that need to know from your broker what that is a CFD you're buying or the real thing you're buying.
Yeah. I'll do so. Thank you.
Yeah.
Thank
But yeah,
you
you can check the reply I gave you, although I've said what I've said in the reply, but you can still check it out.
That's fine. Okay.
But yeah, CFDs are they're actually quite good CFDs because they make because just like you said, sometimes when certain financial instruments are difficult to find where you are, just like you said, if you want to buy this, like you said on the platform, the ETF is not available in UK. So because it's not available in UK, those who want to buy it in UK, the best way you can access this is to buy something close to it, which is where the CDF comes in. CFT, sorry. CFTs come in. I mean, it's actually very common in Africa because obviously sometimes it's difficult to access the UK, basically the Western stock market and stock exchange is difficult to access it directly from Africa. So you find out with most brokers in Africa, those who want to invest in the US stock market, UK stock market, European stock market, they tend to have to do that via CFDs. So they'll be buying maybe people in Nigeria, Ghana, Rwanda, wherever. When they open a platform based in Africa, the platform will be selling them CFDs, a derivative of Facebook, Twitter, and all these things.
Thank you. Thanks. Thank you.
Pleasure. Any more questions?
Sorry, I only just signed up to the platform yesterday, so I haven't had the chance to go through the different topics. It was helpful that you that you sort of reminded me about dollar cost average, that's really to do with the funds.
Yes, index funds. Index
funds. Do you have recommended index funds on this platform?
No, you know, I try and avoid to recommend anything so people don't sue me. I don't recommend anything. I can show you certain, just like this ETF. I didn't recommend it. I just, as you can see, I was just talking about the beauty of ETFs that it gives you the ability to track a sector that you're interested in, but it's for you to still do your homework. Because again, that's my disclaimer. I don't make specific recommendations for fear someone come and say, Remy said I should invest in this. I've lost money now. It's Remy's fault.
Oh, it's okay. My $50 has gone up by 25 cents this evening.
Good. Awesome.
Into the I think it's Admil. I keep getting the name wrong. Admiralty.
Fidelity.
No, this one, the blockchain.
Oh, Admiralty. Oh, the blockchain. Oh, this one. The CFD you bought.
Well, I'm hoping it's not a CFD. I'm hoping it's actually an ETF, but it probably doesn't matter too much. But yes, that one. Amplify. That's the name.
Oh, Amplify. Yeah. But yeah, if you do go through the topics, like you rightly said, the one you can catch up on is the long-term investing, general topics on the financial market and this theme. So you can go through them and catch up on some of the posts I've made. The aim is to give you direction, but not specific. I won't tell you go and buy something specific. Let me see if I can find one where I would just, let's see. Yeah, here we are. So this is one here that I have put here about 10 dividend stocks with over 9% yield. But again, I'm not recommending them. You have to do your, I'm shocked. I'm shocked I didn't write that. I usually write it that, make sure you do your own due diligence. I didn't write it there, but I usually write it. You've now reminded me. I have to make sure I remember to keep writing that. Let me see if I can find another one. But yes, usually, yeah, I try to stay clear from giving specific recommendations. Oh, here we go. Let's see. This is another one. Yeah, this is actually what I usually write. So you can see here, this is an article I saw on the future of investing, fintech, the fintech sector. So I said for those interested in technology stocks, this article details some stocks of interest. Always important for you to do your own detailed fundamental analysis before you invest in any stock. So yes, there are some articles there where I might give some guidance or point you to something, but it's always with that caveat that you do your own homework and make your own decision.
Thank you.
Pleasure. Any other questions? Okay, so there are no more questions. I wish you all a very good evening, and we'll catch up again on the platform.